Okay, welcome guys to module 7, where we're going to be going through breakouts and momentum trading strategies. And this is probably one of my favorite type of strategy, one that's taken a large chunk of my trading arsenal, and a large part of my focus during my years as a trader. So hopefully I can teach you guys a lot about how I look at these trading strategies. Is something that if you can understand the price action, you have an incredibly good edge at, because on breakouts and when there is momentum, there's generally a lot of volume and thus a lot of order flow. So the more order flow you can read, I believe that the better edge you can have. You can instinctively have an edge on that. So what we're looking at, the way we're going to start the breakouts of momentum, is actually get a little bit of a background structure and framework. The same way we did with the fading part, we're going to try and build a little bit of a structure and a framework so that we can work within and understand how the markets move. So in the previous part of fading, we went through auction market theory. And what we want to go through now is the principle of compression. Oops, definitely does not have two O's. Of compression and expansion. Now you could call, as some people call it, contraction. I say compression, I could say contraction as well. But for the most part, it means exactly the same thing, just basically ranges expanding or contracting. So markets move in waves of volatility. They become volatile, then they die down for a bit, they contract, and then they expand. And that's the nature of how they move. They move in waves. Um, and I like to look at the markets this way, because if you can understand this very, very basic concept, you can understand building a framework behind where to look for these types of trades. So we'll just set out some points so we know markets alternate between periods of consolidation and periods of movement. It's very much cyclical. So just understanding this very basic concept can mean all the difference between trading breakouts the right way and trading breakouts the wrong way. If you can identify where to get involved, this is where you build an edge behind the strategy, not just trading any breakout of any level at any point in time. You want to wait for very specific moments when the markets have energy. Now, we're going to try and build a little bit of a framework again, like I said. So if we use the basic concept like we spoke about um, in the previous module of volatility, or sorry, auction market theory, if we were to draw out, let's say, like we said, that kind of profiling or distribution, something that looked a little like this. Let's say there was 3 profiles here. That would pretty much look like, from a trading perspective, from a actual charting perspective, you'd expect something. And what I'm going to be representing is more um, day, daily ranges. So these are actually daily ranges we're looking at here. It would probably look something like this here. We'll have first initial move there. We'll have a day there, a day there. And then eventually, as these markets start consolidating, they reach a period where they contract. And when you start getting this contraction, this is where you start keeping your eye out for potentially a break. And that's where we could potentially get a move, such as this one to the upside. You can get a move through this area to the upside. Then we start trending higher, eventually till we find a value area. And then we might, let's say, consolidate here for a bit. Then we might break down. But overall, we start using this area as our value area. And you can see very clearly, this is where we're not trading much. And within that range is where we're actually finding what we call value. So we have the market coming down to here, finding support, finding resistance there. And then eventually, like we saw in the previous, we get a situation where we contract and then potentially break out. And that's where we get these trend type moves into a different value area where, again, you can see the daily ranges are basically within this area here. I expand that out. So what are we looking for here, guys? We know our areas. We've talked about this auction market theory. We know that this is basically where we have our value area, where the majority of the trade is taking place. And in these kind of situations, if you can understand how the market auctions from one area to another, you can start building a framework for how you want to look for these breakouts. So in this in this case scenario where we've got the market currently structured like this in here, we're trading between this range, and then at some point, somewhere in here, the market has new information. And as soon as it has new information, it starts auctioning to a different area. It finds new value. It's fine at this point when we're trading between this range. We're trading between this range and this value area. The market has equilibrium, or is in equilibrium, sorry, in equilibrium. And we know that area, that level at which the market accepts price, accepts to do business here, and we have equilibrium. At some point, like we said, the market has new information, and then we see this is our move that seeks new value. And that's how the market moves, guys. It moves from one area of value to another area of value. It finds an equilibrium, it trades there for a bit, then it has new information and needs to shift, it needs to change as a different valuation. Remember that example that we said, if I was auctioning a jet off for £1,000 and I knew it was worth about 1 million, people would bid it up really quickly. If, for example, we finished that auction and the equilibrium price was around 800,000, let's say, and then, for example, this jet company announced that they would no longer manufacture this jet anymore, there would be a short supply of that. That information would hit the market that now this jet, it would be more valuable in the future, and would see higher bids. People would come and start buying it at 850, 900, 1 million, 1.5 million, 2 million, and I would willingly move my price of the jet higher as I realize that they're willing to accept higher prices. So this is the concept of auction market theory, and how, the market ebbs and flows from areas of range contraction. So this is where we have very, very clearly, right in here, is our range contraction. And then this period in here, when we're finding new value, so this period in here, this whole period really, that you can see in here, I'll just undo that. That period is range expansion. So our job is to figure out, when can we identify this, and how can we identify how to trade this on the price side, or what is the order flow going to be like? In these case scenarios where you have these range contractions, you have to understand the psychology of the market. It's been in this area, it's had equilibrium. They know that they're trading at this price, and it's comfortable. Eventually, when the market receives information and moves, longs or shorts, in this case scenario, the shorts. So you could add in a little piece of information here. The shorts are trapped and need to cover. So the psychology of the market as this is moving, once it starts breaking out, you get the shorts trapped. they need to cover. They start covering. Yet short-term traders like myself and possibly yourself that are listening in, are looking to actually buy with that one-way order flow, and then it's a reinforcing positive feedback loop, and the momentum starts picking up, and that's where you start seeing the push, the break out of that range, and that's what we're going to hopefully see on the price ladder. Now, in these kind of case scenarios, what I want to make clear is that traders need to adapt and be ready to go from a scenario where they're selling strength and buying weakness to buying strength and selling weakness, i.e., they need to adapt to a scenario from going, uh, they have to go to buying highs and selling higher, as opposed to buying low and selling higher. So, very big contrast, guys. If you guys are comfortable with fading, for example, in the previous module, it's a completely different concept. And the other concept, you're trying to find a market that's undervalued, and then you're trying to hopefully bring that back into a range where it's fairly valued. Obviously, in this case scenario, you could also say that it's undervalued when it's pushing through those highs and it's breaking out. But at the same time, you have to be ready to buy high. You have to be ready to buy near the highs of the day. For most traders, that's a very uncomfortable feeling to actually buy into the highs of the day. But if you can identify what you're looking for, it's actually comfortable to feel that you've got the momentum of the trading crowd behind you. There's a crowd of people that need to move the market. And if you can feel that and gauge that in the price action, that's where you can start building an edge. So what we're going to do in the next part is actually look into how to identify a potential break. We'll look at daily ranges contracting, look at stop zones, and then we're going to start identifying specifically what we're looking on the price ladder, and then finally go through some price action examples for you guys. I've got quite a few because it's, like I said, it's a big part of my strategy, so I can show you guys a few of the things that I navigate around on a daily basis. So stay tuned, guys.